Good afternoon, everyone. Thanks for coming. Hopefully we'll discover some things together. My name is Mike Paulenoff. I am the chief cook and bottle washer for MPTrader.com. And as you see on the site, we are celebrating the start of our 20th year together. And it's been quite the journey of discovery and everything else. Lots of markets in those 20 years. And that only takes me back to half my career. So yes, I've seen a lot of markets. I've experienced a lot of different setups and conditions, but as usual, as soon as you think you've seen it all, something comes along like now, and you have to relearn. Let's put it this way, learning curves never stop. So anyway, just as a thumbnail of my site, for those of you who are not familiar with it, here is the site, MPTrader.com. We have, if you click on room, this is live right now. And this is from today. It's a running diary, really, of my thoughts, members' thoughts, discussions, all sorts of things. And the basis for it is basically from charting. And so here was the first post of mine this morning. And let's see what time that was. At 7:41 Eastern time. And I was talking about what's ahead, jobless claims, and then the ECB rate decision, and what I thought and what came to mind of import that I thought members would want to see, 2-year yield, and how it's come down and how it's leading the Fed into a rate cut. But I guess Lagarde didn't get that didn't get that memo. And apparently neither is Powell. And so I guess we'll have to see what happens. But anyway, that was at 7:41 this morning. And then I kept whatever came to mind and various charts and economic data, and people reply where you see reply, and there are discussions, and there are disagreements, there are agreements, there are lively discussions about all sorts of opinions on what's meaningful. For instance, today, after the ECB raised 50 basis points, after I made a big deal late yesterday of what I thought was Lagarde being the mouthpiece and the head of the spear for Powell to run interference, she was in a perfect position to have taken his instructions to go 25 and then say, we'll pause or whatever. Even Rick Santelli on CNBC said he thought they would do 0. Well, I'm sure he was in shock, although I haven't seen his update today. Anyway, so we are discussing all this stuff today. And in general, we will discuss just about anything. Here's a chart of Roblox, what it was doing, individual stocks, crude oil, you name it. And what I tend to do and what my modus operandi is for my career has been to do in reverse what Wall Street taught me to do 35, 40 years ago. Was the fundamentals are the only thing that matter. Charts, no one cares. And you look at the chart after you figured out everything else about the stock, the commodity, the index, or whatever it is, the company that you're talking about. And the more I discovered charts, the more I realized that I thought it was the other way around. You look at a chart and you anticipate or you interpret the chart, and then what I do is overlay the fundamentals on that to see whether the fundamentals are in agreement with the chart. If they're not, then we have this friction. If they are, then you have sort of a home run psychological setup that in terms of price will also take care of itself, and they'll go in the same direction. So anyway, that's what I do for a living, and I've been doing it for a long time, and my subscribers and the members of MP Trader, they can chime in and put in their own ideas, their own relationships with markets, and it's a forum for everyone to participate. Okay, so now that I've done my marketing piece, let's go over to the charts. All right, so this chart, let's just start off with this one, and then I'll do a little thumbnail, and then you can ask me questions, do whatever you want, or ask me whatever you want, and we'll dive into things, and we'll see where that leads us. But anyway, this chart is the futures, the June futures of the E-mini S&P. And it goes, what I have on the screen right now goes back to May of 2022. So almost not quite a year, like 11 months, let's say. And what pops out at me, besides the fact that you have all these rate hikes in there, which is in the blue box. By the way, I annotate my charts, as you might have noticed. I annotate them, some more than others, but generally I'm kind of like an event risk and reward type of analyst, where I want to see around where markets make moves, what was going on in terms of the events that could have contributed to the market going one way or another, or contributed to, let's say, the algorithms panicking or, embracing something and taking off. So when you see these annotations, they're for my purpose, for my information, and also for yours. So you can see where, here was the February 2nd, 1st and 2nd FOMC last meeting, where we were at the time, and it turned out to be a bull trap. And here we are now. This is live as we're speaking, and the S&P had a wicked update today. And although we have 45 minutes left, the ECB raised 50 basis points, and the S&P right now is up 65 points. Whether or not it holds, I don't know. But when I look at this chart and I take 3 steps back from it, what I see is a sideways mess for months. Now, if I expand the chart even more, then you start to see where the highs are back here. That's March of last year. And this was the all-time high. So that's the all-time high, lower high in August, lower high in December, and then we had that bull trap. But this is where the market could have really taken off above when it took out the December 13th high, the CPI, that CPI reversal, and it could have really taken that out and basically damaged the bear phase, the bear market from January of 2022, but did not. And here we are now. So what is this? Well, for me, this is at best a neutral market. That's at best. Otherwise, it's a market that's unwinding to the downside again. Now, the question is, of course, interest rates and all that. So the bottom, someone asked, what is the graph on the bottom of the chart? So this is relative strength. Now, this is a 4-hour candle chart. So each candle is 4 hours of duration. If I go over to my hourly chart, here's an hourly chart where each chart is, each candle is an hour. And so this is the most recent down leg. And I see the pattern, and I can see where all the resistance is, all the support is. And by the way, this is TradeStation. I've used it for like 12 years. And for my purposes and for the purposes of the members, it's great. So anyway, so here's a 60-minute chart. And if I want to get even more granular, I'll use a 15-minute chart. Now, this chart was invaluable this week because this was last Thursday, Friday. And this is what we've been doing ever since. So some people see this as a base. I can't argue with that. Up until this point, this morning, I was writing about this being a coil. And I expected it to break down if Lagarde didn't come through with some sort of modified interest rate outlook. Well, I don't know if she did or she didn't, because the market seems to think that either that she has raised for 50 basis points and now will cool off, and so will Powell, or this move is merely and purely a reaction to the government of the United States and Europe and the Swiss papering over some banking problems. I don't know which, but in any event, if there's a measured move, we still have, I think we can go to 40-50. And so where are we now? So 40-50, 39.88. So that's another, let's call it 1.6%. If tomorrow we hold here for the next half hour or so, and tomorrow being a one-way Friday, or a Friday before the Fed, and everybody is now anticipating that Powell is probably going to do 25 and then pause, or the optimism will be rampant, or ramping up, I should say, and we'll get up to that that prior high, and then we'll have to see what happens. Anyway, so that's the S&P, and that's kind of the basis for what I do first thing in the morning. And the reason why I use futures is because it's basically 24 hours. If I use the cash S&P, it's, from New York time or Eastern time, it's 9:30 to 4 o'clock. Whereas futures close, I think, for like 15 minutes after the close of cash, and then it opens, and then it reopens for the rest of the night and into tomorrow morning. So the bottom graphs I use RSI, and I also use MACD, and I don't have my own formulas for that because I don't think it matters unless you have your own computer program, which I do not use. Okay, so let's go over to some webinar chart, it's my webinar chart page, which I've stocked with some interesting charts that you might, some of you might want to see. Let's see if there are any actual. So if anybody wants me to look at anything particular, I can do it on this page. But let's look at some examples. So I had a request from somebody, from one of the members of my own site of MP Trader earlier, for the GDX, okay, Gold Miners ETF. Now, for me, I'm gonna go over to a weekly chart. All right, so here's a weekly chart. It goes back to 2014. All right, now 2011. If I pull the chart, well, I don't want to waste the time to do that. But 2011 was the peak. I will do that. Sorry, I'm going to redo the. I'm going to go back 20 years and see if I can show you what I want to show you. All right. Yes, I can. All right. So this should be 2011. Okay, this is September of 2011. The GDX hit a bull market high at 67 and change, let's call it. That was the end of that. And since 2011, it's basically been on the defensive. However, the bear phase in GDX ended in 2016 at $12. And we've been basically in a sideways digestion period since then. From a more granular perspective, though, the lower high compared to 2011 occurred in 2020, up at 45 and change, almost 46. My contention is that this entire move from July or August of 2020 ended last year in September. And this is the beginning of a new bull phase in GDX and in GLD, where this is the first leg up. We've ended a pullback, and now we're trying to generate another up leg. Much will depend on the dollar. And if I go over to, well, let's use futures, gold futures. Now, gold futures, you see the same correction ended in September of last year. This is the first leg up, a correction. Now, let me go back to a daily chart so you can see these MAs. So here's a 200-day MA of this is April gold futures. And this is the 100-day, and this is the 50-day. And the rest of these are the shorter term ones. I use 1017. So gold futures are trading below, gold futures are trading above all of my trading / investing MAs. That will cease to be the case if gold rolls over and nosedives below 1800. But as far as I'm concerned, this is the first leg up, correction, beginning of something new. Now, of course, if you're a gold file back from the old days, of course, there's lots of competition, and that's why gold couldn't get off the mat for so long, because there were so many alternatives to gold. But in any case, you have to be aware of what's going on with the dollar. And I think the dollar ended like a 20-year bull market in September of 22, which is not a coincidence, because remember, the gold chart shows that we ended a correction in September of 22 on the downside. Well, not surprisingly, the dollar index, inversely related to it, ended a bull market there. I think this is a bull market, the end of the first down leg in a new bear market, or a major correction, let's say, in the dollar. And now the dollar is correcting, biding time, working off this oversold condition. And this is the 200-day moving average. This is the 100-day. Now, the 100-day is interesting because it's down sloping, and a down sloping MA, unlike the 200-day, which is flat, a down sloping MA will put increasing pressure on price. So price came up to meet it, failed the first time. It's coming up to meet it again because of the banking issues, flight to safety, I guess, flight to safety. And now it's banging into the 100-day again. If it can't get through the 100-day and rolls over again, today it's down slightly after hitting it yesterday, then I think what we have here is the 100-day down sloping. The 50-day is the yellow one, and it has curled under. If you break the 50-day on the way down now on the dollar index, I think it's over and out, and we're going to test these lows. If that happens, I don't know what the world will look like, but the dollar will be weakening and gold should be strengthening. So will silver, right? So that's kind of the relationship, and it's an old-fashioned relationship. Of course, now we have interest rates that are an issue. So what does the interest rate market look like? So those of you who have either been to the last webinar, which I managed to mess up because I didn't put my charts in a single tab. And when I started opening multiple tabs, so many charts opened at once, it crashed my system. So no one really got much out of that. In any case, the reason I bring that up is because 10-year yield, this is a daily chart of 10-year yield. This back here is or 0.4%, 0.4% on 10-year yield. And that was, to me, that was the end of a 40-year bear market that started in when I started my career, basically in the early 1980s is when Volcker was going to town. Rates were like 20%. I think 10-year yield on this chart was somewhere like 1580. And he was doing that to crush inflation. Of course, the underlying data of the world was much different than it is now. We have so much more debt, it boggles the mind. So the latitude that the Fed chairman has, I think, to raise rates without crashing and trashing and breaking things is much less than Volcker had back then. Plus the fact that by the time Volcker was replaced, Burns, I don't know. I don't remember. I don't actually. I don't recall. I think he replaced Arthur Burns. But regardless, once Volcker came in, the inflation had been rising for years, and so he came in and put the kibosh on it when inflation was running at 12-13% already. Well, now we have all these other fundamentals that are nowhere near as tolerant of rising rates as the Volcker scenario. So here you have 450 basis points of rate hike on a Fed funds basis, and already some of the banks are broken. Now we can argue that the banks are broke because they were devoid of risk management. And so anybody who was looking over or overseeing, I'm not talking about the feds, I'm talking about the bank management itself. I mean, it seems like that's economics 101, that if at the bottom of the rate cycle, if you buy paper, be prepared, because rates are going to go up and prices are going down. So if you bought it at the bottom of the cycle, your prices are going to be underwater. Just so happens that this was the end of a 40-year bear market, 40-year bull market in price. So anybody who bought up there was buying at the high of a 40-year bull market. So, well, that doesn't feel good. And these banks lost a ton of money. I don't know. There are probably other dominoes, other shoes to drop. There are probably some hedge funds that got caught, not in that particular situation, but got caught in the banks themselves, equity holders. So we don't know. There are probably more shoes to drop and in that situation. Back to the chart, the yield chart shows that we had I think this is the beginning and the end of a bull leg from 0.4% to 4.5, 440. We're having a correction. This is where we are now. And the big level, right now we're at, where are we right now? Right, so we're at 358. We got down to the same place pretty much, 337, as we came down to in December, and again in February, and now here we are in March. So if this level breaks, and this green average is the 200-day MA, so you can see that the 200-day MA is holding up the world here. So if it breaks the 200-day and closes under it, then my work says we have more to go on the downside in yield, and we could go down to 280. Break 3% and go to 280. Now, what will the world look like at that point? Well, I would venture to say that if we break 340 and start to head towards 3%, there's some other things that have been broken, and Powell's going to have to deal with that. I don't know what that is. Neither does anybody else, but that's what the chart is telling me. Otherwise, this is the first leg of a bull market after a 40-year bear market. So for me, this is the first leg up. Wherever this leg ends, whether it takes off from 340 or takes off from 3% or 280, the next up leg is taking this much higher. How do I know that? How do I think I know that? I think I know that because of this chart. Well, I guess since I shouldn't guess where it is, I'll just look for it. Monthly. All right, here we go. Ready? All right. So this is the monthly chart of 10-year yield going back to 1983. Right. So here we are up at 14%. It was higher than that before that, but the chart doesn't go back any further. We went from 14% down to half of 1%, less than half of 1%. But we started to bottom in July of 2012. Now we've broken out. We did that in the fourth quarter of 2022. We've pulled back to the neckline, so to speak, the breakout point. And I don't know if we're about to take off from 340 or we're going to break it and go down some more before we take off. And then we're going up to the fives, maybe even the sixes. I don't know what the world will look like, but let's put it this way. There's either more inflation coming or a debt crisis where Congress can't. They're playing Russian roulette. The dollar tanks, and Moody's and S&P downgrades our debt, and all sorts of stuff hits the fan. But this chart is telling me we have some fireworks on the upside because a new rising interest rate cycle really has just started, and I think we have a ways to go before it ends. So I'm trying to factor that into whatever I do, whatever I look at, and say, well, if that happened, what does the equity world look like? Okay, so let's, I'll just show you VIX since it's sitting here. You're probably wondering what this is. This is my 4-hour candle chart of the VIX. Now, so we had all these lows in VIX, and VIX rocketed into the banking crisis, these banking failures. And after Sunday night's announcement that everything was okay because FDIC, Treasury, and Fed are going to backstop the banks and guarantee deposits. We don't know how large the deposits are, but right now, everyone who has any money in any bank, no matter the size, can rest easy that the money's safe. At some point, my sense is that, the more intervention, the more guarantees that a government lays into its so-called free markets, the less free they are. And at the end of the road, when the equity market can't handle the intervention or the interest rate rise or I look at it like a dam. Every time there's a leak in the dam, the Fed plugs it, and with a finger and another finger and another finger, and pretty soon there are going to be a lot of plugged up holes, but the leaks are going to be springing faster than they can plug them up, because QE for 12 years has created so many distortions and unintended consequences that we don't even know where the leaks are coming from. Whoever thought that, that Silicon Valley Bank would go under? Nobody. So anyway, the fact of the matter is that this VIX chart is showing VIX has come down, obviously, because there's less fear and there's no reason to pay up for protection against the unknown but I see this as a sideways digestion period. And if we start to break down, fine. But as long as the VIX is, say, above 22, I look at this as like up an up move, sideways, volatile though it is, and we could come out of here on the upside, with, to me, means that something else is broken or something else is not quite right. Like maybe Powell does 50 basis points and he's not so amenable to a pause in his press conference. I don't know. I'm just guessing. Anyway, I do have an open mind to all these things, but I think these charts whisper things to us and we need to keep them in mind. All right. So let's go to, we have Teresa wanting to take a look at Netflix. Okay, let me see. I will, let me take the Tesla chart, which is very bullish, by the way. I think Tesla had its bear market end, first leg up, 115%, 101 to 218, pulls back exactly 50%, pretty much Fibonacci, 158, 162, turns up, looks like it's a very constructive, this up move right in here, if you dig into it, it looks very constructive from a pattern perspective. It looks like, tomorrow's an up day that Tesla's going to try to dig into this top, this 1 month top it broke down from. And if it gets through 193, look out. Okay, so Netflix. Now, Netflix is a fascinating one. Actually, I should, all right, hold your breath because I have a beautiful Netflix chart, and it's in this tab, and so far it's loading. Okay, there you go. That's great. All right. So let me get Netflix. This is my quote unquote big technology tab where I keep the mega techs. Okay, so let me go to Netflix. Where are you? Let me use the 4 hour first. And yeah, 4 hour is good. All right. So remember, Netflix was all the way back there, $700 in November of 21. As a massive bear move. All the competition from the other streaming services got plastered in earnings, and then spent April to July in the absolute low zone, 200 and 160, then popped above 200, then had another several months of holding 200, and then popped out of that into earnings in October, went to a new or ratcheted higher to a new level, and now it pulls back and it's holding the upper level at 250 and has since ratcheted higher. And you can see that even though I haven't addressed I haven't looked at Netflix in a little while, you can see where all my hieroglyphics end. It pretty much followed the path that we were looking at the time and got pretty close, got to 278. I was looking for, 380. Was that 278? Oh, no, it's 380 got to, and I was looking for close to 400. And it looks like something ended there. Now, the question is, has something ended in the opposite direction? What I can tell you is this, by looking at it just quickly, that it has a non-confirmation. It made its momentum low back here at this price, 310, let's say, fell off a cliff again, went to 285 on Monday, and made a higher low in momentum, which is important to recognize, which tells me that momentum is not confirming the price action, and therefore we're looking for some sort of indication and signal that Netflix is exhausted, at least near term. So near term being it peaked back in, when a lot of things peaked in the first couple of days of February, which was also the last Fed meeting. And it's had, let's see, it went 380 it went down $100. So 280, 380. So it went down like 25, 27%. And that's a substantial pullback. Now look at where it pulled back to. Whoops. So it pulls back to the ridge that held support the last time it peaked before the final up leg. So if you look at this, you know, we all love these patterns. We can label them. So doesn't this look like a cup and a saucer? I mean, a cup and a handle. And the handle now is pulled back to the top of the saucer or the cup. And now it's ready to go again. Now, this is a very important low, but I would, if I'm looking to buy Netflix and I'm an investor, I'm risking this 273. So I'd give it the benefit of the doubt if it broke the Monday's low at 284.85. Breaks 273, something's wrong, and it's going to dig back into here. I don't want to be involved there. But right now, I'm friendly to it as a technical outlook. I'm friendly to it. Where can it go? Well, it's taking this out. I think it goes and tries to attack the 344 to 375 area, and we'll see what happens. If it doesn't get through, then chances are to spend more time. One thing I'd point out to you is that these charts tend to have a lot of symmetry. It's not because I'm telling you there's symmetry, but I'm telling you because they look, if you eyeball them. So on the way down, Netflix spent from January, the third week of January 22 to the, let's say the third week of April. So it spent 4 months going sideways. It's conceivable that it will spend 4 months going sideways on this side and before it takes off again. So right now we're only a month or 6 weeks into it. So it may be that we're looking at a trading range for Netflix before it breaks out again. And 4 months from now, or let's say 3 months from now, that would put us, where are we? We're in the middle of March. So that would put us in the middle of June. And I would think by then, either Powell's wrecked the economy and everybody's watching Netflix at home, or he's already easing, like say Jeremy Siegel is always ranting about. In either case, I think Netflix stands to gain by that. So right now I'd consider, unless you're a long-term investor, and this is an opportunity to add to positions, that's one thing. If you're not a longer-term investor, you're a swing trader, I'd look at Netflix as a rental rather than being an owner. Okay. IBM. Now, IBM. Let me see where do I want to go with IBM? Okay. Let's do this. Let's put up the daily chart, and I'll swap out IBM for it. Well, now IBM, let me increase this, the length of this. All right. So on one hand, IBM is a swing trader's dream. And I say that if it's not obvious, it's because IBM seems to want to stay between 115 and 120 on the low side and 145 and 150 on the high side. And basically, you could have done this pretty much from November of 20. You could have traded IBM, probably just made a fortune just trading IBM. And IBM, as it appears, if I can get the RSI to show, is starting now. This low is confirmed, a new low and a new low here. This was today, and so IBM was that yesterday, but IBM is confirming these lows. So this is telling me that if I'm looking at IBM, I'm saying, what should I do if I want to get long or I want to cover a short? I'm thinking there's one more little bounce here, maybe 126, 127, rolls over, goes to a new low closer to its prior low zone within the year over year range. And that's when I would see these non-confirmations. That's when I think that IBM would be ripe for another one of these moves. Now, it looks like the yellow average, which is the 50-day, and the red average, which is the 200-day, is about to, or already has triggered what they call is a death cross, the opposite of a golden cross. 50 days to cross beneath the 200, which is not a particularly good sign for anything. The last time, let's say it did it here, that's when that happened. But it's in the range. So I think that what this tells me is that that the next time up, I would reduce my upside expectations for IBM. Maybe it goes from 120 to 130, which would be a nice trade in anybody's book anyway. But it's not, I wouldn't expect it to get through this cross, this death cross, until it goes down yet again after that. So that's what IBM looks like to me. Let's go back to there and let's look at Meta, because Meta is fascinating, and it had a beautiful liftoff after getting crushed because of all the money that Zuckerberg wanted to spend on the metaverse. And now, I don't know what the story is, but he seems to have seen the light of being more frugal. So if I show you so for instance, for me, different time frames tell me different things about what I'm looking at. So here's a daily chart, goes back to September of 21. Here's Meta flying high, spending a fortune up at 384. And here is the low at $88. Now, this gives me some sense of how to manage expectations about on the way up. Now, to me, this up move had such bullish characteristics, which occurred to me on the 4-hour chart before the daily. So every step of the way, I was mapping out patterns that I could associate to it or with it, that would promote the bullish setup. And every time I put a resistance level in there, every time Meta exceeded the nearer term resistance level, it then would pull back and use that resistance level as support, which is classic. And then earnings came out, and that really ripped it to a new level altogether. And I keep getting projections off of higher highs that give me the next one. So today I had written on the site for our members that Well, all week last week I was saying that I don't know what the deal is with Meta, but it's not getting the memo about weakness in the market. And in fact, it looks like it's putting in a bull flag or coil formation that is a continuation pattern, and it looks like it's going to take off. Well, it did exactly what it was supposed to do. For anybody who recognized the type of pattern, up, sideways, up, sideways, up, sideways, up, and upside, and now it's up again. So it looks like to me, unless it breaks 188, unless it falls apart and breaks 188, it's going to 218 to 222. That's what it looks like to me. And I see that it's up $6 now, and it's on a roll. I mean, it looks great. And of course, it's part of the group that is now. Oh, one more thing, the big picture. So here's Meta on a big picture basis. Whoops. And so on a big picture basis, where can it go? And it's in here right now. Get the right color. So where, if it goes to on this chart to 222, 218, 222, where does that put it? Well, I go to my daily chart and I say, well, what does that mean? Well, I have to look at it in the context of its bear phase, its prior bear phase, to get some relative positioning for it. So it's starting to peak into this above the 204, 205, which was my initial target. And now where does that say? So above 200, that's the 38% recovery of the entire bear phase that preceded it. To get to the 50% like Fibonacci recovery rally level, it has to get to 236. And I came up with 218, 220, 222, which is right in here. And right now, I don't have any reason to doubt that it might get there. But as this looks to me after this consolidation, digestion, breakout, that this is the final up leg of this final up move of this up leg. And if that's the case, you have to have eyes in the back of your head. So you keep raising stop, you keep being cautious. Like right now, it's 204. And, I realize that 196 seems like a long way away, but not from a technical perspective. If you're going to give yourself the benefit of the doubt to stay in there, certainly to risk 188. If you're an investor, that's what I would risk. If you're a trader with a more granular outlook, then I think 196 is all I'd risk. Okay, so that's Netflix. There's Baba. I was doing, every one of these charts is like a laboratory, is a laboratory piece of work for me. So I do my work and I come up with where I think it's going. And, who wants to be long a Chinese stock at this point? Well, it's almost screaming to be bought here. The problem is that it hasn't been able, the screaming hasn't produced any upside. So I think it really needs to get above 85, 86 to get any traction. It's 82. And so I don't trust it. Although it's something that you might want to keep in mind if you want to take a flyer. I wouldn't be caught in actual Japanese stock for anything. I'm sorry, Chinese stock for anything. I would use options when it came to this because it's just more prudent. In any case, I think that gives you an idea of, look at Microsoft. Microsoft takes this out, this, the earnings high in early February. It's off to the races, and here's where I think it can go. But you've gotten some idea of what I look like, how I think, and how I talk to the members, and the members respond, and they have their own ideas, and a lot of times their focus is on more of a fundamental tilt or a news related tilt. and how it overlays with the charts, but it all works together to form a picture of what we think is happening both in individual stocks, indexes, commodities, the dollar, interest rates. And for me, every day I wake up and I try to fit the pieces of the puzzle together to try to get a picture of what the day looks like juxtaposed on a larger landscape. Um, so, so for instance, I still think we're in a bear market in equities, and I think we're in a bull market in yield or interest rates, and those two things won't change anytime soon. That doesn't mean that there aren't opportunities in every one of these things. Like, for all we know, Microsoft is going up and Google's going down merely because of artificial intelligence, that there's a spread going on. And I had put a spread on the website a while back, when I guess it was in this time frame when, it was about a month ago, when AI was the rage in terms of Google and Microsoft and chatbot and all these things. And it looked to me like if one wanted to participate on a longer term basis, your hedge fund with billions of dollars, which none of us but let's say you wanted to think in terms of one, you would buy twice as much Microsoft or 3 times as much Microsoft as you would Google, or in fact, you would short Google against Microsoft. But that's a whole nother story. Okay, one more thing. I'll do. Let me go back to IBM and then do PDD. We didn't really talk about oil, but you can see from my chart work that I like this chart. Or you can see why I would like the chart. Last time I looked at it was in here, and it didn't get through the key resistance zone, but it got to it, backed away. This is the 100-day MA, backed away right to the 100-day. 100-day is angled at about 60 degrees. Looks great to me, and I think it's ready to take off and try to dig into this 105 to 120 area. Of course, if it came down and broke, let's say 82, all bets are off. But for now, I like this, and it looks like you can make the case it's a cup and a handle. And once the handle starts to take off, it usually approximates the up leg out of the cup, which in this case would be, let's just say 72 to 100. And it's $35, which takes you to, this 120 area. So anyway, I don't want to run over my time. I think there's probably someone waiting in the wings after me, but thanks for everybody, to everybody for showing up. I hope that you join us on MP Trader so we could get more in depth in things than an hour webinar, but at least you have a sense as to how I think and what I do. And please join us. And David, thanks for inviting me.